Palantir is crashing. Is now the time to be buying puts? Let's take a look at it. So the biggest candle you could ever want to see right here for buying puts just happened. This is on Tuesday, August 19th, 2025 is when this happened. Now, and you want to be sure that you are working with the tide and not trying to go out against the tide. So looking at Palantir's chart right here, it definitely is taking a huge beating. This holds true up or down. 40% of your move is due to the market. 30% of your move is due to the sector. And only the last 30% of your move is due to the stock. So if you're trying to short a stock in a bull market, and I've done it, trust me, I've done it plenty of times, trying to short a stock in a bull market, you're going to lose your face, right? It's not going to go well. Or if you're trying to go long a stock in the middle of a bear market, it's going to go against you just as hard. We want to have everything set up in our favor. So let's start with the market itself. So let's look at the trend of the SPY. And we got the SPY right here. We have the 10 over 20, price over 50, and it still has a buy signal. But the SPY is kind of breaking down as well. You'll notice this yesterday, we had to close underneath the 10 EMA. That's a big red flag to me. In fact, I like to call this red light, green light. Anytime you see it close over the 10 EMA, that's your short-term trend, and it could be moving up higher. Anytime you see it close under the 10 EMA, it's mathematically showing you that the trend is starting to move down, right? That doesn't mean it's going to crash. Don't get my words construed here. What I'm saying is the trend in the short term is moving down. Now, why do we use these three moving averages? Well, the 10 EMA is your short term, your 20 EMA is your intermediate term, and your 50 EMA is your long term. So your 10 over 20, price over 50 shows you a bullish trend. We don't have that crossover just yet on Palantir, but mathematically speaking, this looks very, very evident in the hot and not in the hot minute, in the very near future is what I was trying to say. So your trend on the market's good. Your signal is still bullish on the market. So I'm not even going to sugarcoat it. I'm going to mark the whole breadth red. No way am I giving you anything bullish on that. Next, let's go into the sector. So this is the tech sector. So let's pop open the tech sector right here and let's take a look at it. The fear and greed on the tech sector is still rising ever so slightly. The fear and greed average score is rising ever so slightly. So we'll give you fear and greed being green. But the breadth we just talked about a moment ago is getting more downtrends, less uptrends, right? And we can see here that we're starting to push a little bit lower on the number of buy signals. So breadth right here is going to stay red. We'll give you fear and greed right here. Now we're down to the stock, right? Now we're doing a top-down analysis, right? This is not just Chris trying to promote OVTLYR. Of course, I want you to get OVTLYR, but this is a top-down analysis. This is how I've started every single stock trade I've done for years and years and years. Some people will do bottom-up. Bottom-up means you find a list of let's call it 1,000 stocks, and you go through every single stock. And then you see, okay, which stocks in that sector look really good. And then you start looking up at that sector. Oh, does the sector look good? No, that's too much work. We're going to start with the top down. It's a lot easier that way. So now let's go look at the stock itself. Let's go into Palantir's setup here. Now, first thing you'll notice is we got a sell signal on August 15th. That's what this line is representing right here. So that's not a great start. That's not a great start. We got a sell signal with a close under the 10 EMA on the same date. It had developed this order block right here. And as you know, this is an area of strong resistance. And that's exactly what we saw right here. Next, so we're going to leave order blocks because there is one on top of it. The signal is bearish. We already saw that. It has a sell signal. The trend, the 10 is still over the 20, price is still over the 50. But mathematically speaking, if it closes under the 50 today, with as very quickly as that turned, I could see these crossing over either today or tomorrow. So I will still consider that green today, but in the very near future, that would flip very, very red. And so basically, what about the fear and greed on Palantir? Yeah, going from greed straight into fear as fast as humanly possible. So yeah, this is already sitting in weak sell categories, right? If we had the trend right here, we might even be pushing close to strong sell. So we're not ready to start buying puts just yet. But let's say you are. Let's say you're like, you know what, Chris? I got a good feeling about this. I've done my research and I'm comfortable with taking the risk, saying that it's time to buy puts on Palantir. Now remember, always have your trading plan in place. Never treat your trading as a hobby. This is the greatest game in the world, But you need to treat this game as if you are a professional fund manager running your fund. When you treat your funds like you are a professional fund manager and that this is not a hobby, you will treat it very, very, very differently. You will know exactly where you're going to get in and exactly where you're going to get out. So let's talk about what a put option is, right? So a put option, when I say a put option, I'm talking about buying a put. So if we go into the options chain, we're going to be focusing on the right-hand side. We don't come over here very often, like I mentioned earlier. We don't come over here very often. We're mostly figured out on the left-hand side, the calls. So this is your puts over here. Now, a put option increases in value as the price of the stock goes down. So I'm going to be drawing all over this. Imagine the price of the stock is going down. That's what this is representing right here. Okay. And you can see the long put, and I'll switch to blue for this. The long put is growing in value as the price of the stock is going down. Now, you can pick a strike, and that strike needs to have an expiration as well. And this is important. It does matter where you pick. So let's go to the options chain. We can see over here, there's so many different strikes to choose from. Where do you start? Right? I remember the very first time I looked at an options chain, and I thought to myself, I don't know what all these numbers mean. I just want to make money. Okay. So I'm going to give you Chris's setups here. And of course, do as you want. Make sure to run your fund your way. Looking at this in the puts, I will not buy a put that's out of the money. They are cheap. They are out of the money for a reason. I only look to buy things that are in the money. They are valuable to start with. They are expensive to start with for a reason. They already have moneyness. Moneyness meaning how much intrinsic value it has. Now, an options price is calculated between the extrinsic and the intrinsic value. And let's talk about what these are. This is Options Deep Dive Wednesday, so I get to nerd out on these. So the current price of Palantir, as of the moment that I'm filming this, is 157.75. And if I go to, let's just go with the 175s right here. If I go to the 175 strike and I say 175 minus, so that's the strike price, the current price, 157.75, that gives me $17.25. Now, this value is exactly precisely this number right here. It's almost like I know what I'm talking about. That is your intrinsic value. That's how much moneyness this is worth. Meaning, if it expired today, this option would be worth $17.25. That's the moneyness we're trying to maximize. Now, that's not the price of the option today. No, in fact, the price of the option, if you were to buy it, is $20.05. So we take $17.25 minus $20.05. And this is your extrinsic value. This is how much will decay. And it will decay on the call side. It will decay on the put side. Every single option, every single expiration, every single stock, every single time has extrinsic value. You get to choose how much of that in relation to the total price that you have to pay. Now, it'll say 265 here versus 280 because it's taking the midpoint right here. It's taking the midpoint. That's the difference. So $2.80 is how much of 2005? So 2.8 divided by 20.05 is only 13.9%. 13.9% of this option will decay. So let's take a look at one of my favorite slides on here. 13.9% of this option will decay. Now, if you bought an out of the money call, 100% of that option will decay. Let's talk about that. Remember, we're trying to maximize the intrinsic value. How much would this be worth if it expired right now? That is our intrinsic. Extrinsic is our uncertainty value. We don't know what's going to happen, and we have a uncertainty value associated with how much we don't know what's going to happen. Now, if you bought an out of the money, let's say you bought a 125, 100% of this is extrinsic value. Every bit of it is extrinsic value. And let's say I did 175, right? That's a $50 difference between the two. It's expensive for a reason. Only 265 over 1725. Let's just use the 13% again. Actually, which one was that? 2.8, 265. Yeah, that's the one we were talking about. Okay. 13.9% of mine is going to decay. So if we look at what this looks like here, over the next X number of days, and you can do this on any one of these expirations. I just like 21 days to expiration to start with, so we'll start here. September 12th. Imagine today is August 20th, August 21st, August 22nd, August 23rd, August 24th, etc. Over time, this is decaying, and it's decaying by a factor of 100 divided by 23 days, 4.34% per day. It is losing value. So imagine you decided to take an investment, but every single day it loses 4.34%. That is a hard foot to start on, right? That's a really bad place to start. However, if we have only 13.9% divided by 23 days, that gives me 0.6% will decay on a daily basis. Big difference, huge difference, tremendous difference, right? Let's see, 4.34 divided by 0.6 is, it's 7 times more decay. So while you're probably saying to yourself, yeah, you know what, this one's way cheaper, I'm going to go with this one. In fact, it's 7 times more expensive because it will decay 7 times more per day on a percentage basis. Does everybody understand that? Let me know, audience participation right now. If you understand how this option, even though it costs less in dollars, is 7 times more expensive than the one that cost more in dollars, type of number 1. If that doesn't make sense, type of number 2. Type of number 2. What I'm trying to get across here is that this value will decay. This value will decay. The proportion of what this value is and this value is to the total price of the option is exactly where it's coming from. Is exactly where that's coming from. Okay, cool. Lots of good ones. Thank you guys. This is my favorite time of the week where we get to nerd out. My second favorite time is when we get to do bingo. So Richard asks, why would someone do that then? Because it's cheap. Because it's cheap. In fact, I like to put it this way, right? Both go to 0 at the same time on the extrinsic value. One of it's only 13% of the price. The other is 100% of the price. On the same day, at the same moment, they will both be worth 0 in extrinsic value. One of these is a lotto ticket. Well, I messed that up. Hang on. One of these is a lotto ticket, which is what a lot of people are after. One of these is a leveraged investment, which is where I'm after. Right? My goal is not to have fun in the market. My goal is to make master of the universe money. Okay? We're not treating the market like a lotto ticket. We're not treating the market like a hobby. We are treating it as if we are fund managers. And when you treat your investments as fund managers, you treat it very, very differently. That's a great, great question. Okay, so now we've talked about in the money puts versus out of the money puts. But what does that really even mean, right? This is the long put. This is when we're buying a put. Now, to buy a put, you click the ask button. And I know that that sounds so basic, but remember, there was a point in time where Chris looked at this exact options chain and said, I don't know what all these numbers mean. I just want to make money. I remember the day that I did that. I don't know what all these numbers mean. I just want to make money. So what do? Right? You would click the ask button. So you would click where it says 2005. Okay. Just like that. Now, if you happen to click the other one, the 1975, that changes everything. That changes your trade fundamentally, truthfully, upsy downsies. Okay. Now, what do I mean by that? So a long put is where you've purchased the put. Now, remember, a long put increases in value as the price of the stock goes down. Price of the stock going down, the long put will increase in value. A short put is the exact opposite. Imagine these two people transacted with each other. A short put means you sold it. A long put means you bought it. These two people would be transacting with each other. So if your long put increases in value as the price of the stock goes down, what do you think happens to the other party? What do you think happens to the other party? If your option that you bought goes up in value, I'm looking for audience participation here. If your put goes up in value that you bought, the person that you sold or that you bought it from, who sold it to you, what do you think is happening to them? It will decrease in value for sure. It goes down. Exactly. Because they're taking the opposite end of their trade, right? They're going to lose in that case. So a short put, a put that you sold, is a bullish trade. A bullish trade, yes, down in value, precisely. Everybody's getting it. Very good. Look at this. I love doing this. I love learning this. I love teaching this. So this is a bullish trade. All right, where this is a bearish trade. Now, between these 2 points here is literally about, I don't know how many pixels that is. If you sell the put, it is a completely different trade than buying the put. And it's just as easy as going over one column. Like, it is legitimately very possible that you sell it when you accidentally mean to buy it, or buy it when you accidentally mean to sell it. I've done it. It happens. If this ever happens to you, what would you do? If this ever happened to you, what would you do? I'm looking for audience participation here. If this ever happened to you where you sold it when you meant to buy it, or bought it when you meant to sell it, what would you do? Get out fast. Close it immediately. You don't have to cry, Richard. Don't have to cry. Panic immediately. Close it. Close it ASAP. Yes. Reverse the trade. Exactly. Right. Everybody makes mistakes. Right. It happens. We are all human. Right. Your goal as the fund manager of your account is to say, my bad. Let me do the right way. You might make a buck. You might lose a buck. It just happens. Okay. It's happened to me a handful of times, even this year. And I've been trading for 16 years. Right? Accidents happen. Your job is not to be like, well, you know what? I'll just hang on to it. It'll be fine. It'll work out. No. And you definitely don't want to freak the F out. Michael Ross, the boss, has it exactly right. You get out, and then you put on the trade that you meant to do. Right? You put on the trade that you meant to do. It happens. It happens. So now that we understand that this is a bearish trade, the long put that you've bought, versus a bullish trade that you have sold the put, right? What are we looking for? What are we looking for? We're looking for the price to go down. However, remember, we can't set any expectations on this. What could happen? What could happen is you immediately get in and it turns back up. Totally could happen, right? Or it could continue down. Totally could happen. One of these two things is likely to happen, but we don't know which one of those things. We have an educated guess. We are taking our leveraged investment. We are working with the trend. We're working with the market. And we're saying, okay, based on all the data that we have available. Yeah, exactly. Blame Chris if it doesn't work. I get it. I've got a lot of that lately. Blame Chris. If it doesn't go your direction, or if it does go your direction, what are you going to do? What are you going to do? Well, first, I would never, ever, ever set a profit target. Because let's just say that, let's say that 130 is your profit target, right here. Let's say 130 is your profit target. There is a chance that it goes to that point. But let's say it goes to that point and then it blows past it and it goes down to 60. Will you have sold when this happens? Or are you going to continue to hold the trade all the way down? Most people set a profit target and then they will wait until the day it's hit. And that may be years. And I'll give you an example on AMD. These people who bought in July of 2024 might have had a profit target of $200. So let's just put, actually, let me clear a bunch of this stuff off. Remove 5 drawings. And let's draw this up here. They may have had a profit target of $200, right? Right around there. So when they bought it, they're like, here we go, $200. Oh, wait a minute. Oh, snap. Oh, this is not good. And then it comes back up and they're like, okay, it's all good now, right? I've only gone from 180 down to 157. Everything is great. Oh, no. Oh, no. Now we're down at 130. Oh, it's okay. It's come back. Now it's at 173. Everything's fine. I'm going to hit my $200 target here any minute now. And then it goes down and down and down and down. And it got all the way into the 70s. So you're down over $100 a share. And I can tell you for a fact, a lot of people did that. How do I know? How do I know that a lot of people did that? Because the very first time it came back into this area, it got monkey hammered back down. The second time it came back into this area, it got monkey hammered back down. These trapped buyers are getting out as fast as they can back to break even. Their prayers have finally been answered, right? They've been laying in bed for the last 2 years saying, please, Lord, baby Jesus, let me get out of break even on AMD. Because they watched it go from 180 down to 75, back to 180. And they're like, oh, here we go. I have to get out of here right now. And that's why AMD is really struggling. That's why AMD is really struggling to get through this this giant order block right here. But additionally, remember, they had a profit target of 200. They had a profit target of 200. I don't know when that's ever going to happen. You don't know when that's ever going to happen. And because neither of us know when that's ever going to happen, we can't hope and pray or ever set a profit target. We can't set a profit target because we don't know when that's going to happen. So if you're in Palantir and you're trying to short it and you've decided that you're going to hold it till 130, you really don't know where you're going to get out, right? You really don't know if it's, or I should say when you're going to get out. You don't know if it's going to be next Tuesday. You don't know if it's going to be 2 years from now when it finally gets to this level, right? Setting profit targets is a fool's game. Setting profit targets is a fool's game. So what do you do in this case, right? You need to have a game plan of where you're going to get in and where you're going to get out. And let's just say, for example, you decided to get in today with the expectation that you have a bearish trade, right? Where do we get out? Well, first we need to establish our stop loss. Our stop loss is when it's going the opposite direction, right? A winning racehorse does not back up into the gate. I am of the persuasion of putting on a bigger size and taking a smaller stop for that exact reason. If it's going to work, it's going to work. And I want to work with it as big a size as possible. If it's not going to work, it's not going to work. And I don't want to have to wait weeks to find out if it's not going to work. So I would put a half ATR as my stop. Now, the ATR value is 725. And look how much this is elevated. 725 today. Just a couple of weeks ago, it was down at 525. So what is that difference there? $2 over 525 is 38%. The volatility in Palantir has increased by 38%. If you're trading the same size here, and the volatility has gone up by 38%, you're taking 38%, more risk than you would be than you were just a couple of weeks ago in the same stock. So you can't trade the same size. You can't trade the same size. But your stop loss actually is a little bit wider here. Now let's talk about that. Let's say if we had a stop and we're using half of an ATR at 525, that means our stop is $2.62 below our entry point. But if today it's at 725 divided by 2, gives you $3.62. So one entire more dollar of stop loss that you could take in this case. It's a huge difference, right? What is that in percentage terms? 262, 1 divided by 2.62, 38% more. Duh. Oh, it just started raining here. I heard some noise. I'm like, what's going on? It's starting to rain outside. That's okay. So we have 38% wider stop. However, if we have a 38% wider stop, I just earlier talked about, where's my slide? We just earlier talked about how I'd like to have a bigger size, but a tighter stop. This is the formula that I learned from a $1 billion hedge fund manager on how to set the position sizing. You take your account balance and you multiply how much risk to your portfolio you're willing to take. And then you divide it by 2 times the ATR, and that gives you the number of shares you can take. Now, I like to use the 80 delta. That particular options contract was around the, where's delta? Around the 80 delta, right? So I would take the number of shares and then divide by 80, and that gives me the number of option contracts. So let's do the math here real quick. And let's say that our ATR here was 725 and 525. So this is today. This is 2 weeks ago. 7.25 and 5.25. Right? Yeah. Okay. Now we're going to divide that by 2. And that is our stop for when we put on the trade, right? Where we're wrong, we're going to get out and we're going to give it this much room. Okay, so we're actually going to give it more room here. However, what position size do we need to use, right? So let's use these numbers here. So let's say we want to use a $100,000 account and then we multiply it by our risk percent. So 100,000 times 5 is 5,000. So we'll do 5,000. That's how much risk to our portfolio we're going to take. That's not portfolio size, risk to our portfolio. And then we divide it by 2 times the ATR. So we're going to go this, and we're going to divide it by, that divided by 2 times, this is the ATR value. 344 shares versus 476 shares. Right? That's a big difference there. And then we're going to divide that by 80 to get the number of option contracts. So you could do 6 option contracts 2 weeks ago, but for the same amount of risk today, you would take only 4 option contracts. Now, this is really deep, right? That's the point of Options Deep Dive Wednesdays, is we want to get really deep. We want to get really nerdy, right? So now we've established where we're going to get in, why we're going to get in, what vehicle we're going to use to get in using the long puts. We've established how much room we're going to give it to find out if we're wrong, 362. And we've established what position size we would be taking, 4 contracts or 344 shares. We've gone a long way through here, right? This is how you need to think as a trader, right? It's not, oh, stock go down, oh, buy put. Oh, stock go down, oh, buy put. Right? This is not caveman. Stock go down, I buy put. Stock go up, I buy call. There's a lot more to it than that. There's a lot more to it than that. So let's set our levels here real quick. And so let me remove this. Let's set our levels here real quick. And let's say bearish ATR levels. So let's say if we got in here, and then this is that half ATR I was telling you about, volatility sizing for our stop loss. So this is the 3 point whatever away from our entry point from here to here. But let's say that it's working. Let's say that it's working and it does work for us, right? Do we just sit there and hold and hope for the best? No, we actually have a very ninja hack that I love to use. And just this week made a huge difference in my portfolio. So this is what's called rolling an option. Now, rolling an option is, it sounds more complicated than it is, but you're taking this option, and after you have already hit a profit target of whatever that target is, and we'll talk about what that target means in a minute. We're not setting arbitrary targets here. We're doing it on purpose. After it's hit that certain level, you can roll the trade, meaning you would close the original 175 and get closer to the money. Maybe it's the 170s. Maybe it's the 165s. When you do that, you take in credit. So if we originally bought this for, let's just say $23, and then we're able to roll it, and let's say we rolled it for $4, that means 23 minus 4 is $19 of risk. Instead of $23 in risk in the trade, we now have $19 of risk in the trade, which means we've reduced our risk by 4 divided by 23 by 17%. We've taken 17% off the table. This is outlier voodoo. Yeah, it's one of my very favorite things to do. Outlier voodoo. So next, we would add in 1 ATR and a 2 ATR just to start, right? You know, hopefully all goes well and you get to have 7 rolls. But we can't control that. We can't control that point. So earlier when I talked about setting profit targets, we understand that these may never ever be hit. In the history of time, they may never ever be hit. But if they are, that is now my my trigger to roll the trade that we talked about a moment ago, right? When we roll the trade, can you roll up closer to the money and out if you need to, based on expiration, for a credit? If you're doing this and it's a debit, you've done it wrong. If you're doing this and it shows a credit, you are doing it right. I'm telling you, if you've clicked all the buttons and it says debit, you are adding risk, you are adding to a loser, you are not freeing up capital, you are not taking profits. You've done it wrong. Stop what you're doing, clear the trade, start over. It happens, it's okay, no big deal, right? We're all human. As one order, sell to close the original position. So in this case, it would be, remember, we already bought the, in fact, let me draw on this. We already bought the 175s here. So now we would click the bid button and that would close the original trade. So this trade would go away. And then we would come over here and let's say we buy the 165s. We'd be doing this maneuver here. So we're clicking this button and clicking that button. When we do this trade, it nixes out, it completely changes and removes the 175 off our portfolio and gives us the 165s. And in this case here, if we went from 175 to 165, remember we take $7.50 in credit, $7.50 in credit to do that, which means that we just took $7.50 of partial profits now. We just freed up $7.50 in capital per contract now. And the best part about it, you cannot do this with stock. It keeps the trade on. It allows you to still continue to use the trade, still continue to have that bearish thesis, that bearish intent, that bearish posture that you set up originally. So we're not setting this as a profit target. This is really a trigger. If it hits this level, it's a trigger to roll. If it hits this level, it's another trigger to roll again. And this is a pretty comprehensive plan, right? So now you know when to get in, when the whole tide is shifted. Don't do it right away. You know how much to get in. You know where to get out if you're wrong, where to get out if you're right. And at the end of the day, if you don't position size correctly, you're gonna really get screwed. So having that position sizing, as we talked about earlier, is a key crucial part in your position sizing based on volatility, not just on gut feel. Not just, oh, I did it this much a couple weeks ago, I'm gonna do it this much today. Because just in this one stock, we showed how you'd have a 38% bigger position 2 weeks ago than today, because it has 38% more risk today on the exact same stock. So listen, that's my options deep dive for the day. And if you're ready to save time, make money, and start winning with less risk, click one of these two videos, and we'll talk soon.